Welcome to the Royal Ties Podcast. My name is Clark, the Financial Credit Coach, and I will be bringing you information acquired through first-hand experiences in order to help you increase your credit score, reduce interest rates, increase savings, and eliminate debts. Doing it for the community, from the community, and by community I mean any and everyone who wants to learn and evolve. So let's get right into it. Welcome back to the Royal Ties Podcast, where we decode the complexities of personal finances for our Canadian audience. I'm Clark Cadet, your host. Today, we're going to clarify a concept that often puzzles even seasoned financial enthusiasts: the difference between soft and hard inquiries. Insert some applauding and cheering here. Anyway, we'll explore this through different experiences, but the experience of Helen, a budding entrepreneur from Vancouver who learned about these inquiries the hard way. What are credit inquiries? Before we dive into Helen's story, let's break down what inquiries actually are. Because people ask me all the time. I do webinars and speaking engagements, and it's one of the first questions. Well, in simple terms, a credit inquiry occurs when a business checks your credit report to make a decision about you. And that business is usually a bank or a credit card company. These inquiries can be categorized as either soft or hard, and understanding the difference between them is crucial for managing your credit score effectively. Let's talk about Mary. Actually, her name is Helen. My bad. Let's meet Helen. She decided to start her own graphic design business. As she set out to secure funding and resources, her credit report underwent several checks. Woof. Well, you'll see why I'm doing that. Helen, however, wasn't aware of the distinction between soft and hard inquiries or their implications on her credit score. Soft inquiries, what you need to know. I'm gonna give you guys the just what you need to know. We're gonna make this one short and sweet like all the rest of the podcast episodes. Let's talk about soft inquiries. These occur when you check your own credit score, when a company pre-approves you for an offer, or when businesses like your utility company check your credit for background purposes. Like you're applying for an apartment, it's a soft check, or you're applying for a new Hydro-Quebec bill. Those are soft inquiries. The key point about soft inquiries is that they do not affect your credit score. They don't hurt you. No pain. Soft. It's pretty simple, right? They are only visible to you on your credit report. Helen experienced this when she subscribed to a credit monitoring service. Sorry to say it, but you shouldn't be subscribing to those things, man. Anyways, get a financial coach. You'll never pay for those things. She frequently checked her credit score to ensure it remained healthy as she planned her business finances. Good, very smart. These checks were soft inquiries. All good things. I just don't like that she had to pay for them, because you don't if you have a good financial coach. He'll set you up right. Hard inquiries. You got to handle with care. On the other hand, hard inquiries happen when a financial institution checks your credit as part of their decision process on your credit or loan application. Unlike soft inquiries, hard checks can affect your credit score and are visible to anyone who views your credit report. So yes, it shows. If there are too many hard inquiries in a short amount of time, it can signal to lenders that you are higher at risk. So if you apply for a bunch of stuff and it shows up all on the credit report at the same time, and then somebody else checks, it's like, eek, you're thirsty for some money, we should be worried. Helen learned about hard inquiries when she applied for several credit cards and a business loan within a few months. Each application resulted in a hard inquiry, which collectively began to dent her previously excellent credit score. Keywords there, I'll let you figure them out. Helen's realization. So, as Helen's applications were processed, she noticed her credit score was dropping. Concerned, she consulted a financial coach who explained the impact of hard inquiries and how they had contributed to her lowering score. She reached out to me, all right? No secret. And I was like, yeah, that's fine. It's because you didn't have me to help you do it the right way. You could have applied for all these things and not had your score drop so much. But now she's my client. She no longer has those issues. We fixed it. But this was a crucial moment for Helen, because as she realized that the need for a more strategic approach to credit applications was there, she understood why having a financial credit coach was so valuable. Managing credit inquiries. So from her advisor that she had before, Helen learned valuable strategies to manage her credit inquiries, right? But she learned them in the hard way by having to go through them. So limit applications. Only apply for new credit accounts when absolutely necessary. Space out your applications. If you need to make multiple applications, it's better to spread them out over time to lessen the impact on your credit score. Pre-qualification. Check if lenders offer an option to pre-qualify for credit using a soft inquiry before proceeding with a hard inquiry application. This is important. You can do that. Get a financial coach to help you. You're thinking about applying for a bunch of new credit? I have the ways to get you through experience, to get you through that so it harms your credit the least and you have the best chances of approval. Armed with this new knowledge, Helen became more judicious about where and when to apply for credit. She prioritized her applications based on her business needs and potential impact on her credit score. Make sure you like, follow, and share. Tell a friend to tell a friend. Let's bring financial literacy to an end. Helen's story is like so many other people's story. She literally needed a financial coach to guide her. Again, a coach and an advisor are not the same. An advisor guides you where to put your money, how to invest it, and do things of that nature. A coach really cares about the money you currently have, the credit you currently have to get you to your next goal. I have to make the distinction all the time because a lot of advisors' clients end up becoming my clients and I have to clean up their mess with all due respect to their trade, but some people overstep their boundaries. Know your lane, know your role, but make sure you're taking your clients to success always. My name is Clark. You know what I do. Holla at me. My name is Clark, the financial coach, and my motto is simple: pay attention or pay for lack of attention. Please follow me at Clark, the financial coach, on Instagram.